Good morning, good afternoon, good evening, everyone. It's always great to interact with young college-going students or just pass outs to tell them what the world outside, when they reach out to us for funding, looks like. Um, I've been angel investing for about 7 years. I look at early stage, idea stage startups, whether as part of Rajasthan Angels or as my own angel investments across India. I have invested across various sectors and continue to do so. And now I'm leading an initiative of Thai Global, which is the Indian Angels program, which is the Thai India Angels. And I think we will be working with all of you when you want to be written a first check in India. And we have a Thai Global Angels program in the US for the people who are in the US. So over to you, JP.
So yeah, very short about myself. One, I love teaching. I do a lot of teaching at lecturing at Georgia Tech, Georgia State, obviously Thai University. I have a orphanage that I support in Nepal, and I teach finance class and wealth class over there. So it's always a passion of mine, having gone through this nightmare of never-ending capital raising, to share a few tidbits of the entire process. I had my own hedge fund over 20 years ago, and sold it after 15 years, and raised, personally, I helped raise about 800 million on that side. The fund, we grew it to about 1.7 billion, and it was sold to a UK-based hedge fund. But I'm a balance between serial entrepreneur like Mahavir. I do a ton of angel investing. I've probably done 5 deals in the last 6 months. I've got 5 deals that are in my inbox that are going to get funding here, hopefully in the next few months here. So I'm very active from an angel investing standpoint. And I love seeing the relationship between the different stages of building companies and how the relationship from early stage all the way through IPO, post-IPO financing, which I've done some micro cap, bulge bracket type financing, institutional financings, and then building my own companies and raising capital. So I've always been on both sides of that equation. And so what we're trying to do today is really walk through what is it in that process that can give you guys some practical process. And that being said, not everything is as quantitative as you might like. And some of you might like more of the qualitative and the personal relationship component. And it's almost like, I love this game that I play called the game of Go. If you've looked at all in the artificial intelligence space, AlphaGo is this artificial intelligence system that was able to beat the grandmasters of Go. And the reason why I bring it up is Go masters are typically classified in 2 types of people. People that have a feeling for how they play the game, and then the other ones who are very calculated and very quantitative in their approach. And depending on your personality, you may lean more towards one or the other, but a combination of the 2 is going to get you to be effective as you go through this whole journey. So, and the key is, it is a journey. It is not, I close the capital and then magically everything's done. It is a full-time job. I always say, very seriously, I have 2 full-time jobs. One is always raising capital, and the other one is building my business. And it doesn't really stop. So when you're going through this process today, what you're trying to think about is, what are the questions for your own company that can tactically get you to short circuit the entire process, so you don't have to waste as much time learning how to raise capital. So I know, Mahavir, you've raised a ton of capital, and you've also invested in companies. When you're looking at a deal, how much does track record and history and experience from the entrepreneur make a difference when you're looking at a deal?
It does help, but obviously it adds to the value, their experience. But if they're fresh out of college, if this is their first startup, if their education is good, we do a little more diligence in terms of their abilities to pull off the technology or the product or service that they're trying to do. So it really does, your past success, past experience does validate what you're trying to claim. But I personally feel that even if you're fresh out of college, and you have a good rounded off team with technology, marketing, sales, operations, etc., in place, I think we can take a chance and see if we can invest, and you can pull it off. So a little more deep diving, but it works either ways, in my opinion.
Yeah, one of the things I recommend early on is when you're raising capital, if you don't have experience, especially if you're trying to raise a lot of capital, try to find, your initial board of advisors or board observers or even board members that are seasoned entrepreneurs. One of the things that I was lucky enough for almost every one of my companies that have been successful is that very, very early on, I was focused on bringing together seasoned entrepreneurs within that space. Now, they didn't have to be the founder, they didn't have to be, they didn't have to have a major exit, but I found people that kind of filled out my group and the expertise that I didn't have and the things that investors and any business would be looking at to kind of fill in the gaps. And that I think allows you to circumvent the process of needing to have a lot of the track record yourself. The other thing that most investors are going to look for is a big opportunity. And we're going to go through each one of these in detail as well. And Paul, please keep me accountable on time. And also, if you have any questions, just put it in the chat. I've got the chat window up, or you can raise your hand. I think we'll be able to figure that one out as well. But so right now, I'm actually, two of the deals that I invested in through Thai Atlanta Angels is about to have a liquidity event. One is a partial, actually, both are going to be partial liquidities. They actually asked us if we would like to be completely bought out of the deal. One is it's about 100% return in about 24 months. The other one is about a 300% return from last August, which is very high rate of return. And we think that company can IPO and get us anywhere from a 10 to 20x return based upon kind of what their projection and their track record has been. So one of the things when you're writing a check, whether it's 10, 25, 50, $100,000, whatever it is, there's an expected rate of return that's got to be able to be achieved with the investment. And that's a function typically of your opportunity size. And we'll go through a little bit of that in detail a little bit more, but from a startup perspective, it can be a little bit intimidating that somebody's saying, I'm going to put in $1,000 and I expect $50,000 to come out of it in a 5 to 10 year time frame, somewhere in there. So it's a very, a lot of pressure that gets put onto the entrepreneur, but a lot of it ends up being, do you have a big market that you can capture and go out in there? And the other thing is, if you have the ability, especially with being a part of the Thai University program, a lot of entrepreneurs, I'll be honest, everywhere in the world have a very difficult time of understanding how to scale globally. And Mahavir, I think this is a great place of how do you, or how have you, I know you've had businesses, you've been here in Atlanta, you've had operations all around the world. Can you walk us through, when you're starting up a company, is that something that you're thinking about, the global opportunity for a business that you're going to be doing, or somebody else is going to be?
It's always good to be ready and to plan for the market that you want to reach out to. Obviously, you have to do your pilot in your city or in your state or in your country, as the case may be initially. But your vision and your expansion should be global, because technology, as you know, JP, has no boundaries. And a US company will be entering India, and India will be entering Europe, and Europe will be entering China, and China will be entering, so it's very, very tough. It's very competitive. It's lots of mergers and acquisitions, and the world is a market. So if your product or service is going to be delivering to the world, it's obviously great to have insights into what the other market needs, what the other market challenges are, what the competition in the other market is. And that's all very, important, because before you write that slide with the market, the world market that there is, the immediate TAM SOM, that you can show. It's very critical that you analyze the market and see your roadmap. So it's very, very critical. And I think every market, every consumer, every enterprise that you are trying to sell your product to has different needs, different requirements, different challenges, but it's good to have everything in place with something that works across various ecosystems.
Perfect. Now, the early stage of any company is a big question mark, and especially when it comes to financials. And I've talked to a ton of VCs, even deals myself. Early stage investing is really believing in you as the entrepreneur and trust vis-a-vis. And we'll go through that as well a little bit later. But the big things that we'll go through on how to understand financials and stuff has to do with, do you understand how the business model works? So it's not necessarily that this is the truth of the future, let alone the next 12 months in your pro forma statement. But it's being able to understand and communicate a story with the financial model to your investor and explaining how it's going to, how the system actually works. Now, hitting all your numbers and scaling it up very rapidly can be basically impossible relative to the plan that you've put out there. But that's kind of already taken care of in the whole valuation process of figuring out a discount rate. Now, most financial statements early stage, if you go through a discounted cash flow model of valuation, are massively discounted, meaning the probability of you hitting your numbers is less than 20%. Or an 80% discount rate against what it is that your model is actually showing. Now, I'm not saying that you need to be doing a DCF model for valuation for a seed round or early stage investing, but I do think it's important for you to understand what is it that investors are thinking about when you show them financial statements. And it also shows your professionalism. I know from very, very early on, before I even start a company, I'm always building pro formas to really understand how my business is actually going to work and what are the interconnectivities behind that. So when we go through the performance and financial section, that's going to be a critical component. The other thing is, how do you know what the most important things are, or KPIs, and key performance indicators? What are the key performance indicators in your industry? What are the benchmarks that other companies have done in your industry? And how are you going to be able to track that as you perform and scale? And that's where you have to think beyond the financials. There's other things that drive your business, and being able to measure what drives your business is critical, because it's going to ultimately drive up into your financial statements and being able to produce that for investors. For myself, for my own companies, we do quarterly prepped financials. We actually run through the process similar to a publicly traded company of having 10Ks and 10Qs, publishing those from the beginning of the company. The reason why I've always done that is because the level of professionalism that's typically expected from a startup is little to no communication. So if you are giving monthly or quarterly updates, quarterly financial statements, and you're showing the progress, you're going to build a relationship with your investor very early on throughout the journey, so that 9 times out of 10, if you already raised capital, you're probably going to have to raise more capital. So the key is, are you building a professional relationship over time in addition to the personal relationship? Mahavir, any thoughts on that?
No, I totally agree with being proactive about sharing and disclosing your growth, your challenges, your pivots, if at all. So it's rather than you being chased by your investor, it's always good to be proactive and share all these key matrices with the investor, because you like it or not, but the next round, his or her role is going to be very critical. Even if they don't co-invest, even if they don't, but their recommendations, their network will definitely help you. Valuations, at early stage, idea stage, work a little little differently across different geographies. So they're a little different in India than they are in the US. And what JP was trying to say is, irrespective of what method you think is right, whether it's TCF, whether it's what's happening otherwise on the ecosystem, what's unique in what you're doing, et cetera, you really have to have logical reasoning why you think your valuation should be what you think it is. It's not about you being right or wrong. It's not about what the investors agree, or what you agree on eventually, and what works, or whether you agree to a lower valuation, take a smaller round now, wait for 6 months, scale up and show month on month growth, and then raise the next round, or break it into two tranches. It's whatever the case may be, but you really need to have logical reasoning behind valuations. Valuations are just not numbers that can be picked based upon the projections that you've given for the next 3-5 years, or whatever you feel should be the right valuation. And that's why, going back to JP's earlier point on having the right advisors and mentors on your board that you can have, who are neutral, who are not investing, who don't have equity, who are not exiting, they are the people who could probably tell you what the right valuation is. So that group of people that you can reach out to is very, very critical. And asking them not just what the valuation is, but why and why not, is very critical, because that will help you when you are pitching and when you're negotiating with the actual person who's going to invest in you. It's very, very critical that you know what you're talking about, and there's some logic, some strength in the reasons that you give for whatever it may be, whether the valuation is higher, lower, or your fund requirement, whatever the case may be.
Perfect. All right. So let's jump into it. So track record and opportunity. So building a story around the team is very critical, especially from the trust factor. So when it comes to trust and building a relationship with your investor, it's going to be done in a variety of ways. I was talking to an entrepreneur earlier this week for lunch, and she was asking, I don't do a lot of these activities that investors do. What I said to her is, neither did I. I had to figure out how to build a relationship with investors where they are. So yes, there's going to be, the Thailand Angel Group or your local group, angel groups, or friends and family. But typically, the beginning investors are going to be looking at their relationship to you more than their sophistication around the company. They ideally want to see that you either know how to run a business, and if you don't know how to run a business, are you attracting a board of advisors that has that experience like we talked about before? You should definitely use the Thai ecosystem to find mentors to help you with that process very easily. I literally cannot count how many thousands of entrepreneurs in our community of Thai that have already gone through your journey that you're just about to start. So there's really no excuse to email the heads of the Thai University program to get you connected to a mentor. Actually, a couple of the students who had presented the last time that I was helping out actually reached out to me. We've had multiple sessions with them. I've probably met with them a half a dozen times to kind of walk them through. I have entrepreneurs that constantly are coming to me asking, from my perspective, having gone through the process, I join a lot of these boards and become advisors to a lot of these companies. And the things that advisors are looking for are you very serious about what you're doing? Now that sounds very obvious, but because you're in school or in college, there's a big question mark on how serious you are to build this business. But it's a catch-22 in the sense that you may say, well, in order for me to quit everything and focus on this company, I need to raise capital. But the capital is saying, the only way I'm going to invest in you is if you quit what you're doing and focus 100% on this business. And if you have parents, they probably say, just stay in school and get a job. So it really depends on what your ecosystem is. Having started companies on my own while I was in college, really, it was very hard to raise capital. So most of the businesses that I built were service sector based, that I could get up running, generate revenue without raising capital. And we did extremely, extremely well with an international distribution company in the late 90s in the DVD industry. But I didn't need that much capital. And a part of it was because I had a difficult time raising capital. So they do want to know how serious you are about your experience. Javier, any thoughts on if one of the students are very serious about building this company and the risk factor of them being in college and maybe quitting versus pursuing it as an investor? How would you look at it, and any advice on there?
So I really am not in the favor of quitting your education and starting on something that is still an idea. I think unless you're very very secure, unless you have a good proof of concept, unless you have a good team of people working with you who are dedicated as much as you are, and you are the right team to deliver what you're trying to deliver, I would not take that extreme step. I could take a sabbatical. I could, take a break. I could focus on one or the other, or I would do both at the same time. Quite honestly, I mean, it's not only that starting an idea from scratch is a challenge on your mentally. Peer pressure, college education, degree, career, financials also play a very, very critical role. Unless you are pretty strong and secure in more than one ways, I would not do that. Or unless you have nothing to lose, if you were to take a 1 year break and try this idea and go back to education, I would not, I would be skeptical and not quit and start doing it unless I was very sure of the idea and the idea was proven beyond doubt, in my opinion.
Yeah, as a follow-on, having built those companies, it wasn't, I remember it was I was actually in my third degree. I was literally so I went to Georgia Tech here in Atlanta, and I had a full ride. I was actually netting out positive cash flow from my scholarships, and I actually used those scholarships to try to get some of my ideas off the ground. But it was in my third degree, because I kept on going to school trying to start companies because I never wanted to get a job. I just wanted to start a company. That I finally was able to get my business up running, generating revenue, and took it seriously, and then quit college to go and build the company. Thankfully, it ended up being a success. But that was right before that. There was 4 other companies I started that were failures. So I think that it is good advice, because the college ecosystem also gives you a great advantage of building relationships. Nowadays, almost all the big universities have an entrepreneurship program. They have incubators, they have business accelerators, and you want to build relationships with your classmates who you'll probably end up doing business with in the future. I know even today, I actually had one of my students from 18 years ago, 16 years ago when I started lecturing, that is actually my head of analytics and underwriting today in my company. He helped me in one of my other companies. He went on, managed tens of billions in the pharmaceutical world, built artificial intelligence systems, and then fast forward, he now moved back and he's working for my company now. So that ecosystem is always going to be there, but you want to take advantage of where it is that you are and all that connectivity. So one of the first slides that I usually have for any presentation about my company has to do with the team, their track record, what they've achieved in the past, and I can borrow from their expertise, borrow from their milestones to tell that story, to give a level of comfort. So for example, in one of my companies right now, Leap Credit, we talk about one of my business partners built the largest consumer lending in my space. They went from 0 to 100 million EBITDA before the last crash, got it to 400 million EBITDA after the crash, sold it in 2013 when they were doing 600 million EBITDA. It was a multi-billion-dollar exit. My other business partner was one of the first employees of another startup, grew it to $500 million in revenue. and then IPO'd that company for $5 billion on the New York Stock Exchange. So I didn't have that expertise. I know what my strengths are. I'm good at communicating, finding people, telling stories, and then attracting talent. And you've got to know what your strengths are from that process. And I'll tell you, the 16th time around, it becomes a lot easier. But I'll tell you, you've got to be able to go through that process as quickly as you can. Fail quickly, fail forward. That's one of those things that you hear in the marketplace. I will tell you, there's a problem with that as a dilemma, in the sense that a very strong entrepreneur is very tenacious, doesn't want to quit, is going to try to figure out how to solve the problem and get to the other end. On the flip side, you got to know when to quit. So when is it the time that the company's not working, it is failing, and you're holding on to it too long because it's your baby? So being able to differentiate the two really comes down to finding advisors and finding people that you can surround yourself, that you can trust, and gain guidance from there. Also in that slide early on, I also put in my board advisors or board members, their background and their expertise, so that other people, when they're looking at it, one, they can do due diligence. They can call one of the board members, especially if they're well known, and say, hey, what do you think about this company? How are they running it? What's your involvement and stuff like that? And that gives also another level of confidence from there. Javier, any thoughts on that? Or
no, I totally agree. And you know, sharing your vision, listening on to your advisors, giving them due respect in what their opinions are is very, very critical, because you know, I've been wherever we've been advisors on, or wherever we've been earlier investors on, we get called upon by follow-on investors, and they ask very simple questions. And this is just a couple of days ago. Where do I see the company? I mean, it's an entertainment media company. So I said, you know, this is right now in-person reality show kind of a company, but we can look at gaming. We can look at multiple other things that can happen with this company. So you have to really be aligned to the advisors and early investors, so that you're all talking the same language. And when they talk to prospective investors,
अंकुर सर तेरे साथ कल अंडे मतलब तुझे करना है
yeah, so basically it's very critical that you align yourself with your advisors or earlier investors. I totally agree with that.
Perfect. Okay, opportunity size. So we talked a little bit about it, and you really need to communicate, especially if VCs and angels want to know that you know your market better than they do, right? Most of the time, my investors are not experts at my industry. Now, some of the VC, if you're going to raise VC funding, they're going to be probably a better expert than you in most cases. And you're not going to be able to BS them around the stats of the industry and the growth and opportunity of the space. So you really need to make sure you know your numbers. And you know, I think early stage analysis on your market is pretty critical, meaning like, is it growing? And a lot of that has to do with, have you done the research required about your industry? One of the things that I don't do as much anymore, but a lot of my team members do, is we subscribe to every email list in the industry. So we're getting daily reports in the industry, growth metrics, performance metrics, you know, new laws, new regulatory structures. If you're not already in that ecosystem and you're not part of, you know, the conferences, the big groups and associations within your space, you're going to have a hard time being able to be most up to date when the conversation comes out about the marketplace. Some of the things that I always look at, because I'm in a consumer lending space, highly regulated, I'm always looking at regulatory risk. I'm always looking at what the greater markets are doing, such that, you know, is there, you know, going to be higher unemployment during COVID? Is there going to be a big demand? We experienced both. There was phenomenal demand after COVID hit the US markets. We were able to expand exponentially. And on top of that, we had actually been talking about that prior to COVID even hitting, that a recession hitting the US marketplace would be to our advantage as more people would have an increased demand in lending. So you've got to know that conversation very fluently and know how big that market is. You got to do the due diligence. You see it on every single slide when you're presenting, which is how big is your market? And then your addressable market, your specific addressable market, or SAM, how big is that? And then what is your approach to being able to scale into that marketplace and capture it? And so there's the market opportunity, and then that connects with the market strategy of how you're going to be able to market the product or service and be able to capture that market space. And I think that you've got to be able to understand your differentiation between yourself and everybody else. One of the early #1 questions that comes up from every investor is, why would I give you money if all these big guys are out there and they're already taking up such a big part of the market? So are you just another business that's doing the same thing, not differentiated? Because if you're not differentiated, you're not going to be able to get a great return for your investors. Now, on the flip side, in our marketplace, I had experts who had helped build. I had helped build business in this industry. So I kind of knew the marketplace. In fact, all of my competitors were former customers of mine. And I actually really understood what it was that they were doing. And my advisors, one of first couple co-founders, including Paul, were all in the lending industry. And so that helped kind of validate what it was that we were trying to go after. Now, what our differentiator was, we were really good at technology and artificial intelligence. And our industry was very backwards, still very backwards years later. In fact, I don't think in the next 7 years that my industry is going to be able to catch up to what is, just traditional reinforcement learning algorithms, machine learning models that we know how to implement. So that was kind of our edge: automation, machine learning, and being able to introduce it with seasoned expertise, because we knew what we were talking about and we had that expertise. So those are kind of the two big things as far as understanding the opportunity. Mahavir, any thoughts or insights?
Yeah, so I just like to add to what you've said, and not wanting to repeat, and taking Pooran's question that he's typed on this thing. I think the investors or advisors profile, if it helps the idea, if it helps the fundraise, if it validates you as a team or your idea by someone who has been a veteran or who is known, is always great. There's no harm in doing that. If it's a family or a friend or just an investor who's not very well known, or who's not a domain expert or investor, it doesn't really matter, because I would still want to do my own diligence, because I don't trust, many investors wouldn't trust someone that doesn't have a track record. Again, track record investors should be out there on your deck. That's one. Secondly, the market size, the opportunity. Two things I'd like to say. One, of course, is the fact that you should have some sort of a growth model where it should grow on its own, rather than cost of customer acquisition, or the fact that you need a lot of money to grow. It should be growing on itself, and that kind of a product or service and that kind of a market which is untapped does help. If there's a market that's crowded, if there's other people and your go-to-market strategy is different, or your way of approaching customers is different, or your price model is different, you really need to have slides and reasons and justifications on why your model or your idea would work. I mean, I've just recently invested in a fintech company last month, and it's not any different. There's so many fintech companies in India, from Google Pay to PhonePe to Paytm and so on. But still, I invested in this company because it had a very unique go-to-market strategy. I mean, while everyone was doing UPIs and QR codes and debit cards and credit cards and payments and point of sale, this company was doing all of that also. But what this company was doing differently was, it was not going to consumers. It was not going to retailers and telling them, please have my UPI at your point of sale, or use my QR and use my bank. What this company was doing was it was partnering banks, mainline Indian banks, to say that you're going to be losing your business and your retailer, which has loans from you or current accounts with you, to these people who are using this money, keeping the money for a day or two, and then putting it in the bank, and they're your future competition. So what this company did was digitally enabled all the small banks which were not digitally enabled to a UPI QR code, and they already have 100,000 retail customers without spending a single penny on acquiring them, and they're growing 30% month on month. So sometimes, even if it's a crowded market, your other products should really make sense and it should work. The opportunity for a fintech market in India, digital payment markets in India, it's probably just on 5%. We have 100% market to grow, but who will be there? Who will grow? Who will acquire? So that's all very, very subjective. So you really have to show enough reason that you might be the 10th entrant in the race, but your marketing, your strategy, your cost of customer acquisition, your referral program, whatever the case may be, is much better than the others, and why others cannot do what you are doing because they have their other priorities or other challenges. So sometimes having in-depth knowledge of your subject, sometimes despite the opportunities being large, despite the competition being large, your other strategies, your advisors, your earlier investors, your month-on-month or week-on-week growth, all these matrices also do play an important role and do show the opportunity that you are trying to project vis-a-vis what I as an investor see, or someone else as a competition sees. So it's very, very critical to have a fully in-depth but a holistic view, so that you can see direct competition and you can see indirect competitions. For me, Amazon was a marketplace selling products, but now they're into payments. They'll do everything. So for me, there was an indirect competition that did not exist a couple of years ago for fintech payments, but they do exist now. So it's a very, very simple thing that sometimes you don't see competition coming from unknown sources. And we as investors are wary of that. So you need to be really ready to deal with that situation also.
All right, moving on. Okay, performance and financials, depending on who you are, can be probably the most intimidating or the most exciting area of presenting to an investor. For me, it's typically the most fun. I love being able to tell stories with data. And I really think that's how you have to think about it. You can't think of it as this is one gigantic math problem, which it is, but you really need to think about it from a story standpoint. Somebody who doesn't really have context and building up the business from a number standpoint. Now, if you've got seasoned angel investors, they're going to be drilling you on these numbers, and you better know your numbers extremely well inside and out. So what do I mean by that? So let's start with unit economics. How do you make money? So it's 101. If you've got a widget and it costs X amount of dollars and you're going to charge Y, the difference between the two is going to be your gross profit margin. And you've got to be able to walk through that and break it down bottom to top, so that an investor clearly understands how you make money. If you cannot communicate that in a simple way, they're not going to be able to understand tangibly how you make money. Now, a lot of people talk about the industry. They talk about why the product is so great, why there's so much demand, and you're going to make all this money. But if you don't understand it from a unit economic standpoint and can't communicate that, there is no real tangibility behind what is it that you're trying to do. Mahavir talked about cost of acquisition or your CAC. Depending on your marketplace, you got to know that. That's a critical component in your acquisition costs. And then there's operational costs. So obviously in the beginning, you have a huge amount of overhead. You've got, could be people. Hopefully you don't have to have physical location, but if you've got widgets that you're creating, you might need manufacturing support or contract manufacturing. depending on what it is that you're trying to do. But you've got to be able to take all of that math and put it together. If you're a B2B type business, you might have a lot of B2B sales reps that you have to hire early on as you start scaling up. Now, most entrepreneurs in the early stage expect you to be the salesperson, or you or your business partner to be the salesperson, and they don't expect you to make any money or get a salary. It's just the reality of a startup or a seed round of funding. They expect you to be, if you need to be sleeping on the couch or using your own money, go do that. But they're not typically going to look to finance your pocket. They want you to finance purchasing of widgets, your marketing strategy, your sales strategy, and building out the business, but they don't want to put money into your pocket for a salary. Now, having been there, that ends up being the reality, where either you've got to get family and friends, you can sleep on somebody else's couch, you can, get roommates, whatever it is that you need to cut your expenses down to nothing. Early stage entrepreneurship expectation from investors is you are the one who's basically going to be running around. That being said, as you scale up, you need to have more true unit economics that have those expenses in, that have the people, the resources to actually break it down. So after unit economics, and you really give a thorough understanding of how you make money, they're going to want to figure out, okay, what are the things that drive your business? So KPIs and trends, to some degree, it's statistics, right? In the sense that you can paint whatever story that you want to paint. But if you're talking to somebody who's sophisticated and you try to BS your numbers and try to use metrics that are not standardized in the industry, they will call you out and they will make sure that they don't invest in your company. Because if you don't understand your metrics as well as they do, why in the world would they want to invest in your company? That being said, if you're early in the process, get board advisors who are in the industry to show you what those metrics are that are going to be fairly standard in your industry, so that when you communicate them, you have some sense of what reality is in the marketplace. For example, in our industry, in the lending industry, specifically for small dollar simple interest installment loans, number one KPI is what's called FPD, first payment default rate. So that's, I send $1 out of all the customers that I get, what percentage of people don't pay the first payment? So that is like one of the most core metrics in my industry. If I don't know that metric, every investor, so we have an institutional investor, we had VCs, we had other sophisticated people in the space, that was actually one of their first questions. So one of the things that you're also trying to do with your numbers is preemptively answer the questions your investors are going to be asking. So you should have all that information. Now, the easiest way to do that, pitch and practice pitching. The more that you pitch, the more you're going to get these questions. The more you get these questions, the more you're going to be prepared for answering those industry specific. So Mahavir, before I go to the right side on financials and pro forma, any other takeaways on unit economics, KPIs, or any other metrics that we need to be communicating to our investors as we get going?
No, I think you're absolutely right in what you said. I don't have much to add to what you said. I think numbers don't lie. I mean, when you're pitching, you do get overboard and excited, and you oversell your product or service that you've created, that you've fallen in love with. But unless you have these numbers to back them up with, unless you have these numbers in the back of your hand, we will catch you. We're after all investors. We're not your mentors at that point. We're trying to look into reasons why something would work and not work mathematically, and that's what we're looking at, numbers, and we go deep into all these things. So it's very, very critical that you understand them. Numbers don't lie. Numbers cannot exaggerate. And this, while you oversell your product and service or the IP that you might have, but still you run short of money, or your unit economics don't work, those two things don't corroborate. So you have to be really good and make sense why you are not making money despite being so good, or you are not as good, but you will be good after some, so you have to, your story has to be very realistic for it to match your verbal communications to the numbers that you're going to suggest. So it's a very, very important match, and only prudent advisors or mentors will help you reach a synergy which works both for numbers and the growth model that you're trying to project.
Yeah, another thing to add on is use vendors as benchmarks. So when you're getting started with a company, you don't have your own numbers, right? Because you're just sort of getting the company started. So one thing that you can do, and I did even early on in this current company, is I talked to every single vendor and the vendors' competitors to get what are the benchmarks in the industry. Things like, what should my cost of acquisition be? Typically, what's the repeat rate of our customers, to figure out lifetime value of these customers. So asking the vendors in the space, they have nothing else but every positive reason to give you that data, because the more business that you end up doing, the more they win, right? So they want to give you that information. The other thing is, from startup to mid-stage, the story that you're telling is very different, in the sense that you're talking about theory early on and ideas and how it's going to work, or how it should work. So you want to include a lot of industry data to kind of understand where the market's going for the investor. So you may not have internal metrics yet. You should use external metrics, like I said, from vendors, but also industry information to kind of tell what that story is and where you expect the market to go and why is it that you're going to be able to take advantage of it. Okay, the right side, financials and pro formas. Most entrepreneurs, early stage entrepreneurs that I know, are not good at these three statements. The P&L is what most of you probably know, profit and loss statement or income statement, where you get to see revenues here, COGS or whatever cost of goods sold, your expenses related to that revenue, and then your OPEX or your operating expenses. Now, if you have financing, that interest payment is going to be going in there and creates your EBITDA, or earnings before interest, tax, depreciation, and amortization. So it's almost pretty much all that I see most early stage entrepreneurs actually understand. But for a startup, the most important is the cash flow statement. Why? Because a P&L can be a projection of where the company is going, or from an accrual standpoint. You got to know the difference between cash versus accrual-based accounting. But the cash flow statement really shows us as an investor, is this company going to go bankrupt? Do they know how to manage the cash, and are they making it productive? And then the balance sheet really shows about how much capital that you've got, how much capital you've raised, what's the expectations from a forward basis. So one of the things that I do whenever I look at and screen companies for Title and Angels is I look at a balance sheet. How much cash do they have on hand? What's their burn rate from the cash flow statement? And then connect the cash flow burn rate with expected growth with how much cash is left in the bank account to figure out how long it's going to be before they go bankrupt. Unfortunately, my goal when I screen deals for Title and Angels is not to tell you all the reasons why it's going to be successful. It's to screen out companies that I think that in the next 3 to 6, 8, 9 months might go bankrupt because they just don't have enough cash to survive, even if they do have a great idea. So that's where the relationship of having very lean operations relative to how much cash is in the bank and being able to actually bridge that gap is going to be critical in the financial statements. Now, there's probably 1,000 YouTube videos on how to do a P&L, understand the cash flow statement and balance sheet. But the quickest thing that I can tell you is the balance sheet is a snapshot in time versus the P&L and cash flow is cash through time, and understanding the relationship between the two. So I would say that, this is you got to get a crash course on MBA of P&L, cash flow, and balance sheet. There really is no excuse anymore. I'd say maybe pre-internet, pre-1994, you might have an excuse, but even then you've got plenty of accounting books out there. It's one area that I see that creative entrepreneurs do a very poor job of understanding the financials, and they keep saying, well, somebody else is going to take care of it. I can tell you from experience, you don't watch your own financials, I guarantee you're going to run the company in the ground in the early stage, because it can't, if you don't understand the relationship between the two and how that's going to connect from an investor's perspective, they're just going to really say that you're just not ready to take on capital. You need to go through that. Now, as an entrepreneur, I've been through this process several times, right? The number one thing is not me. I'm not thinking daily about my financial statement. I'm thinking about, how can I sell my product? How do I build my widget? How do I just get this idea off the ground? But I can tell you, if you're going to raise capital from somebody who's going to write you a $10, $50, $100,000 check, they want to know that you know what you're talking about from the financial statements. Mahavir, any thoughts to add in there?
No, pretty much. No, pretty much. You're right. I think those are very, very critical. I think even if you're not good at it, you should have a handle on it. There's no excuse that you are a technology person, or both the co-founders are, or all three are. It's very important for you to see the numbers, because that's where your future growth and it is dependent. So I totally agree with you. Nothing further to add on that.
JP and Mahavir, let me ask a question on behalf
Please.
of the students, because in the pitch, obviously they got 10 minutes, but in real life, in an angel meeting or with investors, they could send a package ahead. What's the right balance you might offer them to think about of what to do in the pitch, what to be ready for in terms of, this, what you're showing on the screen can be very detailed or almost to 50,000 feet. What's the right balance?
That's a great question. That's a really good question. Do not put a spreadsheet on any PowerPoint. I will take you out if you do that as an investor. And then don't say, as you can see, and then point to one cell of like 5,000 cells. No, whenever you're doing a presentation slide, there's like, even if you look at this layout of just this presentation, yeah, I didn't put a lot of pictures and stuff like that in here, but you want to have it clear and easy to read on a deck. And we'll go through some of the do's and don'ts at the end there. But even whenever I put financial statements within my data room for our investors, if I'm really going to actually close a deal and the investor's really seriously interested in going through the financials, I do not let them go through the financials alone. Now, everybody else's financials might look clean and easy, but I do what's called GAAP, or generally accepted accounting practice approach to our financial statements. GAAP financials are very complicated. And so I walk my investors through. Actually, it doesn't even matter. We have our own management financials as well. I walk everybody through the story. I do not just send a deck and hope to God that they're going to figure it out, because you have to craft the story, and you have to craft the story from your perspective of why. So, for example, we were pretty, when COVID was about to hit, we were already coming in pretty conservative because we thought there might be a recession in the US marketplace in Q4 of last year. So we had done some things in October of 2019 to make it a little more conservative. When we saw that China had hit in January, we tightened up our underwriting. And by March, we had tightened up even more as shutdown in the US marketplace happened. Now, in our growth projections, we had expected, a massive growth in 2020. But what we said, and we were very purposeful in our communication to the investors, is we don't know exactly what's going to happen, coming in the first couple of quarters of the year. So we're going to pause a little bit. We're not going to shut down operations. We're going to slow down, be very careful, make sure the performance is really good, and then scale it up. And that's exactly what we did. And but if you look at the financials and you just see, oh, it went up and then it's flat, and you don't really understand the story, although most people understand what happened with COVID. In your industry, in your financials, and your story, if you do not craft what that story is, they're just going to look at the financials and they're going to be like, oh, I'm going to interpret your financials the way that I want to, and I'm just going to come up with my own story. Unless you, as the entrepreneur, tell them exactly how to think about the financials and what was going on. So we actually do call outs in our financials to kind of explain what happened when, and what are the things that changed. If we did underwriting model changes, if we increased our market capacity. For example, in October, we went from 7 states of lending to 39 states in lending, right? So if they don't know it and they just look at the statements, they'll be like, so why is this massive jump in October of last year? And so you do want to get very detailed financials. I was going to say before, either go get a QuickBooks account or Xero account or whatever. They can produce the financial statements for you. My opinion is that you should get a bookkeeper pretty early on. I mean, very, very early stage, because one, it's not a lot of dollars to spend, but if you are running around and you do not have the ability to present proper financial statements and you're scrambling for it, I can tell you, if you tell an investor, hey, you should look at this deal, and you haven't really done your financial statements and put it into a QuickBooks or some kind of financial software to generate those statements for the last month, if it takes you 3 weeks to get a financial statement back, they're going to be like, I don't really know what's going on here, but I'm not very interested. The reason why is the most important thing for them is, do you know the numbers? And do you understand how this company is going to grow as a function of being able to display it? Now, that being said, 9 times out of 10, I invest in the entrepreneur at an early stage. I'm not investing in the financial statements. But having the financial statements shows, I don't even look at a lot of these financial statements, but I will say that if I'm looking for Thailand Angels and screening, I'm 100% going to be looking at these financial statements, and you've got to get the basics together. But I wouldn't put a giant spreadsheet in front of any investor on a presentation deck. I would put just the highlights, maybe your top line numbers, your COGS, your expected EBITDA numbers, some of the core metrics, but I would make it nice and clear and easy to communicate. Javier, any thoughts?
No, I think basically you're right. I think in Paul, the pitch or the early, I mean, the numbers and these are not required. I think your initial pitch to an investor in the 10 minutes, or even if it is email, the presentation should be telling us what your strong points are, telling us why we should invest. It should be telling us, inciting interest in us about what you're trying to do. It should be telling us about the team, because most of us at early stage, idea stage, look at the team, their ability to deliver what they're talking about. And if it's a very crowded domain, then talk about the competition and how you're different from the competition. If you have IP or you're very unique, you don't need to talk about what's happening in the domain that you are in. So it's very critical that you have 12 to 15 slides max, no financials at all, unit economics if required, if you're making too much money, or if you are different from what the market generalities are. It's very, very critical that you give us what we need at this point to see, or to seek more questions, to seek more answers, to seek and understand why we would not invest or why we should invest, etc., etc. It's very, very simple, not complicated. But you should, what we are trying, JP and I are trying to do here is that you should know of all of these things. All of these things should add, because these will happen as follow on when you're trying to raise money. These will be required, and if you say, oh, I'll get back to you next week with the numbers, it doesn't go well, because then we see there's something is not right somewhere. So it's very, very critical to be ready and to know this, and your story and your pitch to match these numbers, and these numbers to support what you're talking about in terms of what you're doing. That's why it's very critical to have all of this ready, but sharing in 10 minutes or via email, none of this is required in terms of financials.
Yeah. Pro forma is almost 100% what you're going to be doing from a startup stage, as far as like projections of your financials, projection of sales. And like I said before, it's not truth. It's really getting the investor to understand the business model. And you've got to communicate that. I would say that unsophisticated angels, for some reason, think that this is what's going to happen in the future. I really have not. There's almost zero companies I've ever met that hit their numbers exactly, or even really near to it, from the seed stage or startup stage. So I wouldn't worry so much about that component of it. But if you've got a very unsophisticated investor, just generally speaking, I don't take capital from unsophisticated investors, people who have never invested at all. The reason why is you're taking on a fiduciary responsibility. Yeah, you're not a wealth manager or a financial manager or anything like that. But I believe that, I, as the entrepreneur, whenever I raise capital, I raise tens of hundreds of millions of dollars, that I'm a fiduciary for the investor, especially if they're not highly sophisticated in my industry. So there's a very high level of integrity and ethics that comes into that. That being said, whatever pro forma you show to them, they're going to discount it, meaning they're not going to expect you to hit those numbers at that level. They want to make sure that you have a very good understanding of what's expected out of the business. That being said, you also don't want to short sell your business either. It's a business that you're raising capital for, so it has to be exciting. So how do you temper excitement and projection? And it's showing that you have a lot of information, and a lot of it has to do with operational understanding. You know how to run this business, you know how to hire the people, you know how to scale this business. And if you don't, your team does and has that experience. I think all those components are super critical. For example, myself, I'd already built several companies for this last company. So from an operating standpoint, I don't think anybody's really said, does JP know how to build a business? I'm past that stage. Even though it's another startup, I've already gone past that process. Do I know how to hire people that are going to be effective at scaling the business? I had already done it before. In fact, some of my old team members were coming back on board. So that was pretty comfortable from that standpoint. They know I was really good at the financials, having been in the finance space for decades. And so I started ticking off a lot of the boxes. Now, the big questions that came up for our industry was, well, what about regulatory risk? And so that's where I had to get a lot more education. I had to read laws. I had to figure out Supreme Court cases. I had to really understand those concerns and then be studied up on it so I can answer questions when those would come up as it relates to the company. But from the performance standpoint, I mean, you can say that you believe in the numbers, and you should believe in the numbers. I believe in my numbers. But at the same time, there's always going to be things that come up that are not going to allow you to create that reality of the pro forma. And that's where there's a dating process with your investor as well. And we'll talk about that in a minute here. So I wrote here, protect yourself and the investor. So, and that's really why I was saying, like, you're in a relationship with your investor. I've gotten to the point, and I'll say this advice, and you probably not take it, just because I've been there before. If you've got a sixth sense that says, I'm not sure about this investor, just for any reason, whether it's, I don't feel comfortable with them, but they've got a check in hand. I don't care what the dollar amount is. I remember when we were starting up my hedge fund, and we were early, and there was a $5 million check from an investor. And I just was like, there's something off. And then I found out, and I talked to a couple of our brokers and a few other people, that investor had sued 3 hedge funds prior over the last several years. And, you don't know that all the time, but I've come to really get a sixth sense around people and knowing, should I do a deal with them or not? I've literally gone out of my way and have told investors they're not allowed to invest. I'll say something. The polite way I've said is, I don't know if the risk makes sense for you. I think we want to pass working with you. I have had people who've lost their mind because I've said that. I think in the last 4 years, just from building this company, I've turned down probably $10, $15 million. Because if you can't build a relationship with the investor, when the times get tough, I guarantee you, it's all going to go against you. And I've seen both sides of that equation. I'm probably the worst investor for an entrepreneur in a good way, meaning I don't really ask a lot of questions. I spend time with my entrepreneurs. I do quarterly meetings with each one of these CEOs. I talk to them, ask them questions, see how I can help them out. I don't really care about the rate of return. Now, that sounds insane, but like I said, I with early stage companies, everything has to do with me and the entrepreneur and believing in them as a person. And so when you're going through this process, I know we only have about 30 minutes to go and we'll open up to questions. The valuation cap structure and terms are probably the most dangerous area whenever it comes for you and the investor in terms of protecting yourself and the investor protecting themselves. So let's go this really quickly. So from a valuation standpoint, Mahavir actually made a good point. You know, realistically, nobody's doing a DCF model in an early stage company. What you're most likely going to be doing is finding comps in your area. So for example, I was talking to a company in Silicon Valley. They're raising a seed round. Valuation is at 10 million. And they're raising a $2 million seed round. And I was like, that's definitely not the rest of the world. So you really have to understand what are the dynamics of your ecosystem and what is normal for a valuation round in that space. That being said, you have to make sure you're in the right market. Now, I know we're in a Zoom world and everybody can raise capital anywhere in the world. And the context of what the expectation is a big deal. But the reality is that you need to understand the context of your local community and your friends of friends. The other thing is, you know, if you have the ability, I know one of the reasons why I actually chose to live in Atlanta has to do with my access globally to basically direct flights everywhere I want to raise capital and build business. I had an investor who said, hey, can you meet me on Friday? I think it's literally this Friday, this coming Friday in San Francisco to go play golf. And I'll introduce some other investors. The answer is yes, I just go. And so a lot of it has to do with, are you in the right ecosystem for raising the capital for your industry? So really do a double check on that. Is your ecosystem B2B? So in Atlanta, where we've got a strong B2B marketplace, fintech marketplace, not as strong on the B2C marketplace. So if I'm doing a tech company that's B2C and social media, it should be in Silicon Valley. If I'm building a biotech company or a bioengineering company, I could be in the New Jersey area. I could be in Boston area. If I'm building, different companies have, like I said, different industries by the different cities. I don't know, Mahavir, from an international standpoint, I've raised capital from London through Germany, in Taipei and South Korea, all throughout India and the Middle East. What are your thoughts in perspectives from, you know, if we're raising capital and setting the valuation for those kind of international markets and kind of how that conversation dynamics go?
No, pretty much the same. I think it changes from country to country, geography to geography, domain to domain, and I think it's very, very important to be realistic, to understand what's happening around you, to understand, and you know, the other thing I think more importantly from valuation point of view, and as just to add to what JP said, to say no to a particular investor, you need to have the right investors at the early stage. To have a strategic investor, to have an intelligent investor, to have an investor which would add value to the project that you are into or the idea that you're doing is far more important than a minuscule 10-20% higher valuation that someone else who's just an investor would bring to you. So it's all very, very critical, because this is what lays the ground for your future growth, for your future fundraisers, and the direction that you will be going into.
Perfect. So your capital raise amount, you want to be targeting anywhere from, you know, 12 months to 18 months of financing, because honestly, it's going to take that much more time to get to your next round and hit the milestones and metrics that is going to trigger you going for your startup or Series A or Series B round. And so you need to buy yourself. I really look at capital raise amount, bridging both the business milestones, but also what's going to boost, what are the milestones that are going to hit the next valuation level. So that's a major function of that. So your pre-valuation amount is what it is without the capital. Your post-valuation is you take that valuation, add the capital in, that gives you the post-valuation number. Option pool is pretty common, but be careful on an equity option pool for your startup employees. The option pool is basically a pool of options that gives equity to your early employees. If you don't give that option pool out, it'll get redistributed out to the investors and you'll lose that equity to the other investors in the company. So take note of that equity option pool. Your cap table is simply all your investors, what their structure is, what's the deal structure, and understanding how much capital they've got in and what ownership percentage they have. So that's that first phase. Second is the capital structure. So it really depends on where you are, again, on location in the world, and what's common there. In Atlanta, I don't see a lot of safe notes. I see a lot of convertible debt and not as much convertible equity, although I'm a huge proponent of convertible equity type structures that don't have a cliff on the debt side. So convertible debt technically is a debt instrument. You're raising debt. It has a amortization schedule and interest that is expected to be paid, but typically it is converted into equity. That being said, safe note and convertible equity came into play just so that it would prevent a cliff where the company is in a financial problem because they have to pay all this debt to the investor. So that's where the convertible equity and safe note structure comes in. Make sure you get an attorney. Yes, you can find on Y Combinator's website or Venture Hacks or a lot of these websites to find your own notes. It's great as a starting point. But remember, the term sheet is not the final subscription document. And typically for sophisticated investors, you are expected to pay the bill, the legal bill, to get that structured. So make sure you've got an attorney on your side that's going to be able to help negotiate those terms and then finally put the subscription document together for you. They're not cheap. They're anywhere from $5,000 to $15,000, which is a lot of money for a startup. But like I said here, on these terms that we're going to go through, if you do not get good guidance from somebody who's an attorney who has done venture investing, who's done angel investing, you could get really screwed over. I literally had a friend of mine started a company, grew it to about 120 million valuation. And basically the VC on the second round had the ability to fire the CEO of the company, who was the founder. He was fired, the company started financially struggling, and then they brought him back in to save the company, got the company back up, and they ended up selling it. And they sold it for about 140 million to a company called Tandberg, which then got acquired for 1.7 billion by Ericsson, and it was a huge success. But the entrepreneur was basically fired from his own company, and he gave up those rights, and it created mass havoc and almost shut down the whole company. Luckily, he was able to get brought in, but a lot of that has to do with the terms, voting rights, veto rights. You know, those are typical though. If you've got a major investor, they're going to want to take the ability to prevent you from taking cash out of the system. Those are these participation and liquidity preferences. Each one of these terms are very easy to look up online, how they go into some of these term sheets. Like I said, Y Combinator has these docs, Venture Hacks has these docs, your Founders, I can't remember if the Foundry has these docs, but you can look at each one of them to be able to kind of get the context. So one of the questions is, if you get fired, you keep your share, or can they force you to sell them? Again, that has to do with your waterfall. So if you get fired and in the terms there's a buyback clause on termination, then yeah, you may have given up that right. Most of the time, I don't see buyback of shares as a function within the operating agreement, let alone your own employment agreement. It is typical once you get a VC to kind of lead, they're expecting formal employment agreements to be put in place. But your liquidity preferences becomes an issue. I'll give you an example. Say, for instance, I invest $1 million in your company and I have a 3x liquidity pref on your deal. And you're like, okay, whatever, I don't really understand what that means. And you sell the company for 3 million and you're like, oh, fantastic. I grew the company. Let's say the valuation was 2 million. I own 50%, and you grew it to, we'll grow it to 4 million. So it'll be easier on the math. So you said, oh, well, I doubled my money. Well, the answer is no. So because I have a 3x participation preference on the deal, I get 3 times my money before you get anything. So it means I get the first 3 million, even if you sold a company for 4 million, so you'd walk away with only 1. Now that's not a bad deal in that case, but there are some terms that if you don't know, they could wipe out your entire capital stack before you even get $1. So being able to understand what that waterfall looks like, your expectations of growth, you should have that context before going in, so you don't get screwed over in that process. I don't nowadays see any more than 2x liquidity preference. Most of the time it's a 1x. In my first deal, on our first round of partners, I actually put in a 2x pref for the investors because I had such a high percentage of ownership of the company. That was to protect my investors as well. And I'll tell you, if you go into later stage rounds and you've dealt with early stage unsophisticated investors, if you do not treat them well and do not do a professional job and you screw them over, I can definitely tell you going down the road, the other stuff comes back to bite you in that other investors will be very overly protective and put a lot more restrictions on you because of your lack of taking care of your investor as a fiduciary responsibility. Because early stage investors may not be as sophisticated, or angel investors may not be as sophisticated. So you may be able to take advantage of them, but that will come back to bite you going forward. So those terms I talked about are typically equity specific, all the way down to that preferred equity and conversion line. Common equity is typically what happens whenever you've got a VC and they're going to take the preferred equity, whatever those preferences are. You get pushed down to common equity, which is fairly typical. On each round, subsequent round, the preferred equity shares go to common equity shares, lose those preferences, and the next VC or whoever's leading the next deal ends up getting those preferences. The only times, and I've done this, that you take lines of credit, junior debt, or senior debt, is whenever you are a very strong free cash flow business. In our case, we didn't raise a tremendous, I think that we raised about $1 million in equity. We really didn't need a lot of equity. We generated phenomenal amount of free cash flow. So debt was a function because we were really confident we can pay off the debt pretty easily. But what we did as a sweetener is we added on warrants. What's a warrant? Warrant is just like an option. You have a strike price or whatever the value is that if it gets converted, starts the purchase price of the stock at that level. And it's usually for an extended period of time. You can exercise a warrant typically like 10 years later. And what's the benefit? So the investor who gets a warrant doesn't have to pay the capital gains tax on the appreciation above the amount that the strike price is. Now, below that strike price, you do have to pay capital gains tax, ordinary income tax, depending on the country that you guys are in. I'm not going to go too much into warrants, but I do think it's a great tool as a sweetener to a deal if you're doing a debt financing. But 99 out of 100 as a startup, you're not going to be doing debt financing. That being said, one caveat: my dad did give me a loan at the start of my first company, so I ended up getting debt from family. I still am paying that debt off, I feel like, the rest of my life. But the point is that it's very atypical from there. Let's see, Mahavir, any thoughts or anything on this slide around deal terms and cap structure?
No, I think it's pretty different for India. I wouldn't want to go deep into it. I would rather take questions and see what's relevant to them. I think you've covered it from the US side of it. We'll deal with it when we come to funding, and I think they'll learn as they go.
Perfect. All right, I think we're pretty much done here. This is my last slide. So I wanted to talk to you a few things about presenting. Presenting, it's all about practice. There's just really nothing about it. I did speech and debate whenever I was growing up, and I did a lot of it. And that got me to be really effective at communicating and understanding how to communicate what the main points are to an audience. Obviously Zoom is much, much harder. Now, I even talked to Paul before we were doing this presentation. I said, so what's the time frame of us actually doing this presentation to you guys? And usually I don't talk more than 20-minute segments, just because based on an online format, people really get burned out pretty quickly. And it's just hard for you guys to pay attention. Mahavir and I both have a lot of stories and case studies to kind of give you some context around it. But the key is that you have to be super engaging, exciting, especially online now. And you're telling a story. So that's the first do. You're not talking about a company. I think there's a Simon Sinek TED Talk about how it's all about the why as opposed to the what, meaning like it's not what your company does that anybody cares about. It's why you do what you do. What is it that in your life got you to get to this point to go start this company? Or drive you to go what I call through the living nightmare of this early stage process. It's very uncertain. It's exciting, but it's very difficult. And depending on how long it takes you to kind of get to that next stage, it's very stressful. So entrepreneurs or investors want to know why. And a lot of it has to do with you telling the story. The other thing is, the caveat to that is, if they are not specifically in your industry, do not tell any jargon. For example, I told you about FPD. Nobody knows what the heck FPD is unless you're in the industry. And so in our industry, everybody knows what FPD is. People know, what your expected net default rate of return is, versus you may have different metrics in your industry, but be very, very careful who your audience is. In fact, we typically prepare 3 different decks for our investors. One for somebody who has no clue what the heck that we're doing, one for institutional investors, and one for people who've already been a part of the company and have already invested, and they kind of want to just get an update about the business. So we update those actually every single quarter. A couple of them we update every single month. And when it's the intro deck or intro pitch, it's super short, is just there's no jargon in it. It's just explaining what the heck we do. Connecting at a personal level, another do. I cannot tell you, and Mahavir and I have talked about this before, and the last time we presented this, and I talk about it constantly whenever I talk about raising capital. 99% of the stuff that we talked about really doesn't matter. It has to do with you and the investor. And the reality is, the investor, if they don't know who you are as a person, you got to get to the level where they trust you as a person. Because Thai Atlantic Angels and the Global Angels Group, they're great groups. They're typically focused on companies that are already in growth trajectory. They have some meat to the bones of the company. They're already up, running, and scaling. And so you're telling the story a little bit about yourself, and you're connecting, and it's meeting a criteria for a check to be written. 9 times out of 10, whenever you're in the early stage, everything to do with personal relationship. So I have picked up, I can't tell you the number of hobbies just to build a relationship with investors. I've learned fly fishing, sporting clays, golfing. We're doing hiking trips to Nepal. I do whatever the heck it is. I'm going to ask my investors what they're interested in, and I'm going to go meet them where they are, not where I think they should be. Now, I'm not saying everybody can afford all these things. So in the early stages, it was, it could be going out for a drink, get a cup of coffee, but you got to do it consistently as well. You don't build a relationship because one time you had a meeting and then voila, magically you became best friends. And so that's also where you have to understand that the capital that you're raising is over time, so that you build a relationship, so you're expecting them to reinvest from that side. So I'll pause there. Mahavir, any thoughts or feedback or questions?
I think it would be going too far if they had to learn my hobbies, your hobbies, and so many others. I think if they can stick to their core strength, I think if they can stick to the knowledge of their domain, I think if they can be in love with what they're doing and they can show that to us as investors, I think that's something that's a must do. If you're impassionate, if you're not convinced, if I can convince you of doing your business differently, you're definitely not going to get funded. So you really have to be sure of what you're doing, how you're doing it, why you were doing it, as JP said, and be able to convince me rather than me be able to convince you why you shouldn't be doing that or doing something differently. If I'm able to convince you, you will not get the money and you need to restart or reboot.
So the only last thing I'd say is talking about risk and mitigation. You have to address risk before the investor addresses it. Do not get caught off guard when they say, so what's your COVID plan? Like, I don't know, this is what we think we're gonna do. No. Almost 99% of the time, the things that you had to be talking about is risk management and how you're managing the risk combined with how exciting the story is. So I'm gonna stop there, open it up to the whole screen, and ask you guys to ask us some questions. I know you guys are coming from all around the world, different perspectives, different industries, different ideas, different markets, raising capital and stuff like that. So just raise your hand. Let's see, Augustin, do you have your hand raised? Did you want to ask?
Yeah, that's me. Sorry, my camera's off. Like I said earlier, I'm on a road trip right now and I'm driving. But first of all, thank you guys very much. I really appreciate all the stuff that you've been discussing over the past hour and a half or so. It's been very eye-opening. Something I would ask is, earlier you were talking about how something that investors will look for when they're getting into a venture is, is there that open, expansive, growable market, right? So like, how big is the opportunity really? And then your cash and business make money, right? And so something that we've done at my startup, it's called STG Visions, is we've started to get a lot of customer interest and people are buying our AI analysis, right? But to validate market and validate value, we pay low to kind of get that entry level. Go about.
Augustine, if I can interrupt you and ask you to ask your question, please. If not, we'll put you into chat. And
Can't
you can
really price or sell your product at some top-notch, top-tier value where people don't want to take a risk on something new that's that expensive, right? How would you go about so that investors can then see your cash flows are worth taking a look at, if that makes any sense?
Yep. So Augustine, you cut in the middle. Maybe Paul, if you know the company a little bit, could you give them a little more context? Because I didn't completely understand the question as far as like, you said it was like high price.
Yeah.
Right. So I can.
Augustine, why don't you catch up with us offline and I'll give you a background later on, JP, and connect you guys.
Absolutely, that works.
Perfect. Jeremy, you had a question?
Yeah, well, just a question. You said that you should not let investor convince you that they know better than you. But in the other hand, we may need their insight and their knowledge. So that's why we want them as a part of the team. So how do we balance the fact that they may know better, but we also need to convince that we can do it by ourselves?
So I know, Mahavir, you can definitely answer this question. My 2 cents are, if you're getting a strategic investor and they know you're raising the capital, you're just having them put in capital, but you really want them on your team to help you out, that's perfectly fine. In fact, CEO of a company I'm trying to recruit right now, went from startup to 65 billion market cap. They're one of the largest companies in the world. He was on the founding team. I'm trying to get him on board my company to help us out. I don't really care if he puts money in. He's putting in actually a decent amount. He's going to invest. But he's actually come to our monthly huddles with the team, quarterly retreats. He's actually been a part of the conversation very early on. So by getting him involved in a lot more internal process, they know their expectation is if they believe in the company to quit and come on board, they're probably going to believe in you enough to invest in the company as well. But if you're going to bring them on the board expectation is a little bit different than an angel investor who doesn't necessarily want to get involved from that standpoint. So I wouldn't be too stressed out about you just have to be very clear with the investor. Mahavir?
I think just to add to what JP said, I think a strategic investor will always know much more than you do. because not only does he understand the domain that you're in, he's seen so many like you who've tried to do something similar or are doing something similar, and he's had multiple feedbacks and multiple experiences. So I've always seen that as a startup, you should be, honesty is the best thing that you can do. So be honest in admitting what you don't know. Be honest in changing your gears and say, I'm not looking at you as an investor. Can you mentor me? Can you advise me? Can I do things better? Do I need to change things? So it's always great to be honest to someone who's a strategic investor. And that's probably the best thing that I've seen that works for everyone. And there's nothing wrong in it.
Naga, you have your hand raised?
Yeah, hi. So I have a question about the adaptation of technology or developing a new technology. That is, when it comes to a startup idea. So which is better, developing a new technology or adopting a new technology in the process of globalization?
So that's an interesting question. I like it. It really depends. It really depends on making money. I know it sounds dumb and obvious. When you're raising capital, most of your investors are looking for intellectual property that you're creating to invest in, because you have some kind of edge and protection and what they call a moat around your business that protects your IP. But even then, I've probably filed, I don't know, 4 or 5 different patents. That patent process is not easy. It's extremely expensive. It takes 4 years, 3, 4, 5 years, depending on which market you are in globally. But ultimately, you're trying to build a company that makes money, I hope. There's a lot of companies that don't make any money and keep getting crazy valuations. That's a whole nother conversation. But you're trying to build a business, right? So I wouldn't stress out so much, is it a new or cutting edge or something in existing? Like in our industry, lending is, has been around for, I don't know how many millennia. So it's not like we're in a new industry. And we knew that technology is eventually going to catch up to where we're going. So what we said is, well, we've got time. There's a huge market growth. Nobody's filling it that quickly. And we've got an edge. So we're going to pursue that. My first company that did extremely well was the dumbest business ever that has made so much money. It was a DVD distributor. We didn't do anything. We were basically salespeople. We got contracts in the US to sell to the Middle East and in India. We're a reseller. We made millions and millions. And so I think we were at peak before I sold the company. We were doing like 300,000-400,000 net a month. And I was a teenager. I'll tell you, I don't think anybody cares that it was in sales of doing distribution. It was a business that was very tangible and made money. I know that sounds very blunt and obvious, but it's really, what kind of companies are angel investors, sophisticated angels or VCs going to invest? They're going to look at more cutting edge technology that you have a distinct advantage in. Javier, any follow on?
No, I'm just saying, just to add on, of course, money is important. The question is not new technology or using technology and delivering a solution. What are you good at? I mean, are you a technology person? Can you create, improvise, and build technology? Or are you a good person to deliver something that's usable by the masses with existing technologies, and having to use multiple technologies and put it right, like in a platter that consumers can use or businesses can use? It just depends on what you are good at. I mean, it's for us, we will look at the business viability. We will look at your ability. So if your ability is technology, I would create technology. If your ability is not technology, I won't try and create technology. It doesn't matter. I mean, I've had people who've done, business studies and MBAs and still are running technology companies because they're good at marketing. They're good at go to market strategies. They're good to manage people. It just depends on what you're good at.
Perfect. What other questions? Anybody else have any other questions out there? I'm sure you guys do. We've got a little bit more time to go, about 10 minutes So you guys are more than happy. I know it's always nerve-wracking.
Yeah, and that question.
Go for it.
So actually, before I'd like to mention this that we are currently participating in Health Prize. So it's basically competition on it, which allows young entrepreneurs for so they provided $1 million who wins in this. So in that process, we have made an idea on a company called Aquaform, which usually have developed a technology which we can grow the fish in the cities like urban aquaculture, where we call the theme urban aquaculture. So in this process, it's becoming very hard to attract the investors or mentors into this unorganized sector called aquaculture, which is all about the fish. So in this due process, when I was searching, I found this called crowdfunding or so on. So how it's gonna work? Is it worth it, or is it it's just kind of a waste of time about the crowdfunding?
That's a great question. So I've had companies that I've worked with who've been wildly successful with crowdfunding, and other companies just wasn't even worth the time. So it depends on your country and kind of the structure, because now they have crowdfunding that allows you to give equity to non-sophisticated investors, because the platform that you're doing the crowdfunding from is structured almost like a broker dealer to be able to sell securities. So it really depends on your country from that standpoint. But that being said, it really has to do with how effective are you using social media to build a crowd. If you do not know how to effectively bring a crowd and market people to your product, probably not a good venue of raising capital. Very, very difficult. It sounds easy, but you've got to get potentially thousands to tens of thousands of people to get excited about you, your product, what it is that you're selling, and build the trust and recognition in that process. If you feel comfortable doing that, and a lot of the companies I've worked with, they've got big followings on Instagram. They've done a really good job on social media to build a brand. I highly recommend that you go and do a crowdfunding, because you're basically remarketing through your channels that you've already built up to communicate what it is that you're up to. I remember the founder of Atari put up some game that they were thinking about building. I think it got funded in like an hour and a half, and it was like 10 times over the amount that they expected. Well, yeah, I mean, it's like, from a history standpoint, it's like one of those successful game companies of all time, creating a new game and wanting to crowdfund it. That makes sense to me. But if you have not a very large reach and you're trying to raise millions of dollars, very, very hard to go through that process. Javier, any thoughts?
No, this is good. I'm good with that.
Perfect. What other questions? I think Paul has a short poll after that question. Paul, you want to post that up for everybody?
For some reason, I'm going to ask Darshak or Pradeep. For some reason, my capability is limiting. Are you able to run poll number 4, please? Darshak or Pradeep?
Yes, I'll do that.
Okay.
Poll number 1, let me go to.
I'm going to ask JP and Mahavir a question, actually, on behalf of the student teams. What if I don't want to raise money? What's my mechanism to, not just for the competition, but just, hey, I don't want to give away part of my company. Any suggestions, Mahavir and JP, that you would offer?
Yeah, I mean, now I know a lot of you are in school, but the average successful entrepreneur is not a teenager in their 20s. They're mostly in their 40s or late 30s, from a lot of the data I've seen out of Kauffman Foundation. The reason why I think is because you've got 10 to 20 years of experience, you've got savings, you've been in industry, you know what the gap is in the marketplace, you've identified it, and you know how to bridge that gap. And you, in a lot of cases, those entrepreneurs sell back to their former employees or to the industry or the context that they had already built. So, you know, don't be stressed out if you're not going to build a successful .com billion-dollar company in the next like 3 to 5 years. It's okay. If it takes you time, build your career. You know, Mahavir said, you know, you could stay in college, figure out what to do. Let's answer this question. Wait, the question got ended? Okay, it's end the polling. I'm not going to end the polling. I think you guys can end it on the technical side. But
No, we'll let it run for another 20 seconds. Keep going.
perfect. Yeah, no, so I would say, you know, I bootstrapped the first couple companies I started. One was a DVD distribution company. Didn't have any money. I didn't know how to raise capital. So I didn't. We didn't have incubators back then. I think there was ATDC in Atlanta, but there was no Y Combinator. There was no, the internet was just started. So there wasn't a digital ecosystem for raising capital. And it really was who you knew. And I didn't really know that many people. So I built a business that generated a phenomenal amount of return. And we had a huge exit after only a few years, but I didn't have any capital to get it started. So I used the little amount of money that I had from scholarship to go and start that business. And, you know, we worked it the very long, hard way. So it really depends on kind of what your business, as a lender, I have to raise capital. I'm a balance sheet lender, which means that we don't securitize and sell it on the secondary markets, which means that I have to raise capital basically forever. Thankfully, we generate a phenomenal amount of free cash flow and we do really, really well. But my life is half build a business and operate it and half go raise capital. So it's a full-time job for me because our company needs it. That's what the business model is. If I wasn't in a company, we would need to have somebody to make it successful to be really good at raising capital. So it really depends on that. Service sector businesses typically don't need capital, right? If you're a professional services company, you're doing consulting work or IT work or stuff like that. It's labor specific. And I'm sure Mahavir, you probably voice the same. And if you have any thoughts on there.
No, I totally agree with what you said. The other thing is that even if you don't need money, sometimes a third-party validation with some investment is always good because, you know, sometimes when you're living in your own bubble and you're profitable and you're not burning and you're growing at a pace that you want to grow, it's fine. It's great that you don't need money. But sometimes a strategic investor at your terms, because you're not pressurized on cash flow, you're not pressurized on raising money, you can actually enhance the valuation of a company. So if a strategic investor comes at a very small nominal equity, small sum, not only does it validate what you're doing, also you have someone that you can, that has added value to your company and the valuation goes up. And it would be helpful in opening many doors because he or she is very, very strategic in the domain that you are. And so sometimes, you know, and there's no free lunches as we know. So putting money in does make me take a deep dive into what you're doing, and that does endorse what you're doing and strengthens your team, your ability, your outreach, and your brand.
You know, one thing, you know, before we end it here is just tenacity. I'm just telling you, at the end of the day, you know, and I've always had a, hopefully you guys believe in yourself. I know that sounds very obvious, but you have to believe in yourself ultimately whenever it comes to entrepreneurship. I still to this day will call it the living nightmare, only because as soon as you think you figured it out, it is not figured out at all. And usually every time I feel like it's going well, that's usually whenever I become extremely cautious on how the company is performing and what's going on. But you just have to keep at it. And like I said, there is a component of being able to determine if the company's working or not working. But the reason why I beat out a lot of my classmates who've given up on entrepreneurship isn't because I am smarter than them at all. It has simply to do with I did not give up. And I kept trying, and I kept trying different things. even companies that worked out. I remember when I sold my first company, it was basically the funding for my second company and in the hedge fund space. And we were doing really well. Performance was really good, but we were struggling raising capital. That was really my first how to raise capital. And then the crash happened. Performance was phenomenal, but a lot of the investors, we had what's called a 90-day redemption. You can take out your cash. You email me today, in 45 to 90 days, you get your cash back out. So a lot of our investors were using us as their cash register to take money out of the fund. Well, that's not good. So I almost went to the point where all of the capital, all the millions that I had made from the previous company, I was about to go file for bankruptcy if it wasn't for about, I think like 6 to 9 months. And thankfully it worked out right at the bottom. Our performance was good. We were one of the top 10 mid-markets hedge fund in the world, and everybody got the word how we had done during the crash. And we raised, like I said, almost a couple $2 billion after that. But even if it didn't work out, and you can ask my wife, Mary, we were holding off our wedding for like 3 years, or 2.5 years before we got married, because I was trying to figure out what was going to happen with the company. I am telling you, you just have to keep at it. Now, there's a lot of cyclicality with the marketplace right now. There is so much cash in the system globally because of central bank printing. So for those of us who have assets in our equity markets, bond markets, stuff like that, have had huge growth in our net worth without doing anything, which means that angel investors, there's a huge amount of pent-up cash to deploy it productively in the marketplace. Those people are looking to raise capital between now and I'd say between the next 5 years, maybe even 9 years, give or take. There's just a lot of cash in the system. So I think it's important that you take advantage of this as far as the market is concerned. When it globally cyclically turns over, cash disappears. And when it disappears, if you're in the middle of trying to do a cap raise, guess what happens? All these deals blow up. And don't look at it as just because it's your fault. There are usually a lot of major factors beyond your control of why things don't happen the way that you want to. You just have to have that constant tenacity to create a reality of it. And, having been on both sides of it and actually up and down through the roller coaster, a lot of it has to do with your own internal well-being, mindset, and perspective to remain healthy. That's one thing that people have talked about this last year with COVID and lockdown, your mental health. The mental stamina that's required to be an entrepreneur and serial entrepreneur over decades, it's like being in the special forces. I work with a lot of people in the special forces space here. It is very grueling. It's very intense. You got to take care of yourself. I know a lot of entrepreneurs burned out, blew out their relationships, blew out a lot of personal life responsibilities, and they were not able to sustain it for a very, very long time. It is a sprint marathon. It's the only way I can describe it, because it is lots of sprinting and a very long race that may never end. And it's also addictive. I love building companies. I love the people. I love working with people like Paul. I love people like Mahavir, where we tell our stories and we work together. It is a band of brothers, or it is a family that we've gone through this process. And it's not really dissimilar from each. It all feels like it's happening to you, and you're the only one that's gone through it. But I can tell you from personal experience, there's a lot of people who've gone through that struggle. Take advantage of the Thai community, because so many of us have gone through those ups and downs and those challenges from literally where you guys are sitting around the world. Take advantage. This is really a great time. So thanks so much, Mahavir. Thanks so much. Any parting thoughts?
Kanchan had a question.
What we can also do is take questions. If you guys have some time to stay on and answer via chat, but go ahead and take this as the last one, and then Mahavir, any parting thoughts? So.
Thank you, Paul and Mahavir, sir, and thank you, James. Wonderful presentation. So my question was, if you are an entrepreneur, what are the pros and cons as for you, if you're looking at angel investors versus a group of investors, angel investors versus institutional seed investors?
So basically sophisticated versus unsophisticated angel investors, correct?
It could be sophisticated angel investors as well, and it could be somebody like AngelList, a couple of angels coming together and investing in your company, and the third is the institutional seed investor. So those are three, and I was wondering what are the pros and cons of each.
So I'll give you the short version. So I do a lot of syndications. Paul knows we've done a lot of syndications where there's a lead investor on the deal, and they'll syndicate a whole bunch of other unsophisticated investors in a pool through a single purpose LLC that's going to write a check. Those are great because you don't have the headache of managing 10, 20, 30 people as an investor. It really then it becomes who is your point of contact and their sophistication. So if they're very unsophisticated, that can give you some other headaches, but I love syndicates that I don't have to manage the investors within them, which is why I believe in Thai Atlantic Angels and the Thai Global Angels program, because it is a really good deal for the entrepreneur to really have a single point of contact. Sophisticated institutional angels, they're going to set the terms. And like Mahavir said earlier, if they're well known, it's a stamp of approval, it's a validation, especially if they're globally recognized. They can give you a big leg up on a forward-going basis for your next round of funding. So I typically try to get investors that can help me bridge to the next round, or if I'm investing, I want to help bridge those deals to the next round of investors as well. And then versus individuals, it's usually friends and family. They're great to have. They're your biggest supporters, but if they're unsophisticated, they're typically not very useful, which is why I'd be overly cautious on unsophisticated investors that may be giving you a little bit more money than they need to from a risk management standpoint. So you have to be very careful, because if your uncle or aunt writes you a check for $100,000 and they don't do angel investing, but they're like, oh, my nephew or niece asked for it. It sounds good, but it could cause a lot of problems if they lose that money, right? So, entrepreneurship is still higher risk, right? So out of the 16 companies I've helped build, only 4 have really worked out. Now they've been massive successes, but those other companies that haven't worked out, thankfully, I haven't really lost any money for other investors, but that's a big risk. You take $100,000 check or $50,000 or whatever the number is, it's all relative, and you lose that and it doesn't work out. You have to understand what the consequences are and ramifications from that. For an institutional investor, if they lose the money, I mean, that's what they do for a living. Hopefully they know how to manage their portfolio risk. Have you any thoughts on that?
Yeah, so I'll just answer that question quickly, just to add to what you said and do my closing remarks, Paul. Obviously, when I seek funding today as a startup, you should be seeking funding out to an individual angel or a group of angels, organized or recognized angel networks, or to an institutional, depending on what your next round will be. Where do you want to be 18 months from now? If angels will help you raise that next round, if angels will help you grow to the market that they need to grow, if that's where you should go. If institutional endorsement is required and a fund is more important to you, because you would need larger sums of money 18 months down the road, because you would have done where you would need a huge number, I would go there. This is just at an early stage. You should be planning or thinking of who are you going to and what are you going with at that next round should determine who should you go to today. So it's very, very simple. You should, as an entrepreneur, as a startup, you should be able to see your roadmap for the next 5 years, because this is your livelihood. This is your living. This fundraising is just an interim thing. Whether it comes today, tomorrow, from one person or 10 people or an institution, it's irrelevant. Where is the eventual goal going to happen? Where is the end goal that you want your company to be? Is it going to an IPO situation? Then do you need angels today, institution tomorrow, or you need institution today, VCs tomorrow, whatever. You have to plan that roadmap. That's where my closing remark, advisors, mentors, organizations like TIE, reaching out to people who are dedicated, who are giving time and energy and learnings with you selflessly, hour after hour, is very critical. So reach out to the TIE chapters locally, ask them to reach out to us globally or nationally, whatever the case may be, and we are there to help you. And that's where networking, that's where reaching out to different people, your peers, your members, your network, and to organizations that are global in nature is very, very critical. So, and I thank the entire TIE University team, Pradeep, Paul, whoever else has worked. I'm bad with names, and I thank JP for doing a great presentation as always. I just butt in with my stupid comments here and there.
Not at all, Mahavir. Thank you so much.
Yeah.
It's
JP, it's always a pleasure to co lead or assist you in this. Thank you so much.